Today's video is about 3 books that really changed how I look at money, assets, and building wealth. A lot of what's in these books seems simple, even obvious. But the truth is, most people never think about these ideas, mainly because of how we're raised. From a young age, most of us are taught to earn money and spend it, not to build or invest it. Consumer mindset is the default. Buying the latest phone, upgrading cars, chasing trends, even when it's unnecessary. Rarely do people talk about ownership, building assets, or thinking long term. These books shift that perspective. First book we'll discuss is Rich Dad Poor Dad by Robert Kiyosaki. This is the book that introduced a different way of thinking about money. It's written in a simple and relatable style. Even if I don't agree with everything the author says, the core concepts are useful. The biggest idea in the book is the difference between assets and liabilities. Rich people focus on buying assets, things that generate money. Most others end up buying liabilities, thinking they're assets. Another key point is the lack of financial education in traditional schools. Schools focus on academic or professional knowledge, but not on how to manage money. Without financial literacy, people fall into debt, live paycheck to paycheck, and miss investment opportunities. The author also talks about working to learn, not just working for a paycheck. Picking up skills like sales, investing, and communication is more valuable in the long run than just chasing salary. One of the most powerful phrases that truly stuck with me is, "The rich don't work for money. Money works for them." Building passive income through investments or businesses is how people gain real financial freedom. Relying only on active income, trading time for money, keeps people stuck. There's also a focus on risk-taking. Many people avoid investing out of fear. Wealthier individuals often take calculated risks and treat failure as a learning opportunity. He also explains how wealthy people use corporate structures and tax strategies to reduce their tax burden legally. Understanding these systems is part of building wealth. The book encourages thinking like an entrepreneur and looking at investment and business ownership as paths out of the traditional job cycle. The Psychology of Money by Morgan Housel offers deep insights into how human behavior affects financial decisions. Unlike traditional finance books that focus on numbers and strategies, this one dives into how we think and feel about money, which often matters more than what we know. This is maybe my favorites book. This book isn't about how to pick stocks or build a portfolio. It's about how people behave with money and how psychology shapes financial outcomes more than knowledge does. One of the main ideas is that doing well with money is more about behavior than intelligence. Traits like patience, emotional control, and consistency matter more than being smart or having a finance degree. Another idea is that everyone has a different relationship with money. People make financial choices based on their background, experiences, and even childhood. There's no one-size-fits-all approach. The book also emphasizes the role of luck and risk. Many financial success stories involve timing, environment, and randomness. It's not just skill. At the same time, bad outcomes don't always mean someone made the wrong decision. They might have just been unlucky. Another important lesson is about saving. Wealth is what's hidden, what's saved, not spent. It's about having options and freedom, not about showing off. Compound interest is also a key theme. Building wealth takes time, and the earlier someone starts investing, the better the results over decades. Most of Warren Buffett's wealth came after age 50 because of compounding. The book talks about understanding what's enough. Chasing more can lead to unnecessary risk, stress, or even failure. Recognizing personal limits is a strength, not a weakness. It also points out that people tend to keep moving the goalpost. The idea of making it never feels complete, so contentment becomes part of the wealth equation. Long-term consistency is more valuable than short-term brilliance. Surviving and staying in the game is what really builds wealth. Finally, it's better to avoid major financial mistakes than to try and constantly make big, impressive moves. Playing defense, being cautious and steady, often wins. Peter Lynch teaches you how everyday investors can outperform Wall Street professionals by using common sense, research, and a long-term perspective. Lynch ran the Fidelity Magellan Fund from 1977 to 1990 and averaged 29% annual returns, so he knows a thing or two. His book, One Up on Wall Street, is more about investing in individual stocks, but it's written in a way that's accessible to anyone. He explains that everyday investors actually have an advantage. Most people interact with businesses daily. They notice which stores are full, what products are gaining popularity, what trends are emerging. These observations can lead to smart investment ideas. This is what he means by invest in what you know. But he's also clear that research matters. Liking a product isn't enough. You need to understand the company's financials, its earnings, debts, growth potential, and whether it actually makes money. Lynch also breaks down 6 types of stocks: slow growers, mature, stable companies; stalwarts, big companies with steady growth; fast growers, smaller companies growing 20 to 25% annually; cyclicals, companies tied to the economy's ups and downs; turnarounds, struggling companies with recovery potential; asset plays, companies with hidden value, like real estate. Um, Understanding these categories helps you manage risk and build a more balanced portfolio. He advises investors to ignore market noise. Day-to-day price changes don't matter much if the company is solid. What matters is the company's long-term performance. The best stocks, according to Lynch, are simple businesses with strong demand, low debt, and leaders who own shares themselves. He also talks about spotting 10 baggers, stocks that grow tenfold. These aren't usually the companies everyone's talking about. They're often low-key businesses with strong fundamentals. A stock's price will usually follow its earnings. If a company keeps growing profits, the stock will rise over time. And just like in the other books, patience is key. Lynch often held stocks for years. He wasn't worried about temporary drops as long as the company was healthy. These 3 books approach money from different angles, but together they give a full picture. Rich Dad, Poor Dad shows how to think like an investor and focus on assets. The Psychology of Money shows how mindset and behavior shape financial outcomes. One Up on Wall Street gives a practical approach to spotting good investments in the real world. The ideas are simple, but they challenge how most people think about money. Shifting from a consumer to an ownership mindset makes a huge difference. These books help start that shift. Thanks for watching. I hope you found this helpful. I'll see you in the next one.